Okay, hello everyone. Thanks for joining our webinar today. I'm Sarah Sullivan, CEO of Sugo Capital, and we have also
Leah Slaughter, owner of OmniKey Realty and a bunch of other companies.
awesome. So, what we're going to talk about today is why we're currently investing in Texas and why we're going to continue investing in Texas. But where I'm going to start is at a really, really high level. I'm going to bring up a presentation and I'm going to take just about 15 minutes to walk you guys through. Leah and I, we invest in a similar market, but in totally different asset classes and totally different types of real estate. So I'm going to take just a minute to say, like, here's all these different ways you can invest in real estate. How do you decide what's right for you, given what your life is, what your goals are, etc.? Because what works for one person doesn't necessarily work for another, right? And then once you decide what kind of investing is right for you, what asset class, then there's a due diligence process. And it's 3 steps. And we're going to focus today on the second step, which is market. And we're going to really go into, we have a lot in our portfolio, both of us in Texas. I think 100% of your portfolio is Texas, right?
I have one multi-million-dollar beach home in Florida, and everything else is in North Texas.
Okay, there we go. And yeah, we have a lot. We're buying a lot, so we're not talking theoretically stuff we've seen about there. We're going to share our actual investing experience with you today, so that you guys can decide to jump on in as well, or not if you've got something better going on. So before I bring up my slides and talk, Leah, do you want to give a little bit more about yourself, your company, your background, a more thorough introduction? Besides, what I said, which is I love your outlook that in chaos there's opportunity.
Thank you. Yeah, so my name is Leah Slaughter. My husband and I co-own OmniKey Realty. We're a real estate investment and management firm. We started in 2006 at 18 and 19. All we have ever done is real estate. And we're unique in that we're kind of a one-stop shop for investors at any stage of the process they come to us for. And we really made our name and got our market knowledge and watching these trends back in the crash. And I'll keep it real brief, but if you go back to the very beginning, 2006, 2007, we were doing all of the listings back when they were brand new for sale by owner and owners.com. We were doing Countrywide and America Plus BPOs and doing all of their asset valuations here. And so we were kids calling a crash at the end of '06. And so it's very interesting, right? Because we built our business through the crash, having seen the trends and steering people along highway expansion, believing that that was going to be the most stable opportunity, because we still believe real estate's the best investment, even in a bad market. I don't think we're going to see a bad market in a really long time, but it's a unique model that we came up with. And so it really propelled us to where we are today. So fast forward to today, we represent almost 2,000 investors. I personally own almost 35 million in real estate. I don't do any pooled deals, so that's just 100% what my husband and myself own. And we acquire somewhere between 50 and 100 properties a year. We are in a holding pattern now, very limited 1031 exchanges only because of volume. I couldn't fill them if I needed to. Predominantly, we buy single family homes and generally in far out markets. So we look at the inside area of DFW and we buy one step out where all of the growth and expansion is happening. And DFW, and we'll talk more about this later, is a unique market that allows us to do that.
Love it. Beautiful. So then on logistics, we're recording this, you guys. It's going to come out. I'm going to go ahead and share my screen, bring up a presentation. I just had a sip of water. I'm going to go as fast as I can through my presentation because it's just the baseline. It's just the baseline to get us started today. All right. So Sugo Capital, here at Sugo Capital, we can connect investors to passive income opportunities. So even though what we're going to talk about today are all different kinds, what we focus on at Sugo Capital is connecting you to passive income, to mailbox money, where you're totally hands off. So we currently have a fund and direct investments into syndications, and I'm going to talk about what that is today. And we have a ton, this portfolio, 2,600 units. We have a lot of it in Texas, and there's a good reason. We're going to talk about that. And so why are you here today? You're not here by chance, right? You didn't just say like, I'm going to talk about Texas today because that's fun. We're going to talk about investing because investing is a step to you living your dream life, right? Like we're all investors, we're all here learning because we're trying to get a step closer to living our dream life. So set your financial goals. If you want help getting there, I have an event next week. You guys are going to all get an invitation to it with the replay. It's called Freedom in 3, and it's a 3-day challenge. We're going to talk about how to really set financial goals and take some steps to get there based on investing. And in that event, I'll talk about what this picture is, but it's the day that I realized I'd reached my goals of time freedom, financial freedom, travel freedom. Freedom is one of my core values. So it's a good idea to think about what is one of your core values, because that should always be referenced when you're thinking about making an investment, which is why I don't do Airbnb, which is why I don't do fix and flip, because that doesn't support my core values, but it supports other people's core values. Okay, so we have a lot. This is a presentation I normally give. I'm going to just fast forward and say, I'm not like Leah. I have not been in real estate since I was 16. I grew up thinking that the best way to be financially successful is to get a great job, to get a master's, to climb the corporate ladder, which is what I did until I got to a point where I realized, even though I'm making this great income in Silicon Valley, I'm still living paycheck to paycheck. You have to become a good investor to actually get to financial freedom, to actually grow your money and be able to retire one day. So I started asking people around me, you know, other millionaires who were just hanging out at home, what are you doing? Everyone said real estate. So I started studying real estate 10 years ago, and I studied over 15 different types of real estate investing, and I've dabbled in a whole bunch of different asset classes. And that's how I put together the chart I'm going to show you in just a second. So my results when I started, which was duplexes in other states, because I'm in California and you can't get cash flow in California. People are actually losing money on a monthly basis and hoping for appreciation. Don't invest in California. But I was investing out of state. And the problem I ran into is that the before and after picture, normally they're switched, right? Like you buy something junky, you fix it up, it's great. I bought something that was nice and turnkey. It got destroyed. I lost 75% of my investment because of the people involved. So it was a great house, a great market, but I didn't do great due diligence on the people. And so I always suggest if you have someone else involved in your picture of your investment space, you really need to do solid due diligence on them. A property management company was responsible for this situation. I didn't do proper due diligence. It was in the beginning. Long story short, now what I invest in are hotel syndications, hotel development, and multifamily syndications, so apartments. And when I started investing them as a passive investor, I was getting 18 to 25% annualized returns. And that's when people around me started saying, hey, how can I do the same? And so I started sharing, hey, this is what a syndication is. Hey, this kind of investment might be great for you, with people in my network. And so I had people in California who I would introduce them to properties out of state. So this one's in Texas. It's in Waco, Texas, which we might talk about today. And they get cash flow, they get great annualized returns. This was another person in my network, Emil, who's in Colorado, invested in North Carolina. He had 45% annualized returns. He wasn't on the loan, he wasn't on the deed, he did nothing for this investment, someone else did. And you know, it was just really, really fun to me to connect people in my first degree network with the things that I was investing in personally as an LP. And then I said to myself, hey, what kind of impact could I have on people's lives if I wasn't limited to sharing this one-on-one, you know, with people in my network that I actually knew one-on-one. And so that's when I developed my company, Sugo Capital, and I started doing tons and tons of online education. So now that you guys know me, you're going to be bombarded. Today is an example. Next week is an example. Just like we throw information at you all day long, all week long. And, you know, we want to help you make really great investment decisions. And I think there's a huge gap in knowledge in the people who know what's going on and are making successful investments, and people who don't know, so they're not making great investments, or they're not making any investments. And so a lot of my information is called Confident Investor, because I want people to be confident and have the knowledge to make the right decisions and make great investments for whatever great means for them, right? So next week, we're going to have an event called Freedom in 3, and it's just a 3-day challenge. It's free, but it's how to get yourself to your freedom number. You know, how to get yourself to a point where you can retire, or you have the flexibility to live wherever you want. Whatever your goal is personally, we're going to talk about how to get you there. And so I'm going to skip through this pretty quickly. Disclaimer, we're going to talk about numbers today. They're just numbers. They're not offerings. I'm not offering anything today. We're going to talk about 15 types of real estate investing on the basis of 6 things. Now, these 6 things are going to support different types of investors, okay? So lots of times people, they think about, okay, there's the returns, where there's so many ways to think about returns, right? Like there's IRR, there's ROI, there's cash on cash, there's preferred return, there's all these things. And so it's really important for you as an investor, when you think about your investing goals, what's actually important to you? Is it actually important to you to get a check every month, passive income, or a check every quarter, passive income? Or do you have a chunk of money today and you're trying to build it up to be, you know, a nest egg for a child or a grandchild, you know, to buy a house or to go to college or whatever it is, or for yourself to retire in 10 years, whatever it is, then you're going to have a different investing strategy. Then you're going to be looking for the long run. You're going to be thinking about, how can I actually amplify and do wealth building with the chunk of money that I have? So you're going to be more focused on, what is the IRR? What is the ARR? What is the actual, you know, the biggest overall annualized return I can get? And you wouldn't care about cash flow because it's for some time in the future. Now, different asset classes have different ways they cash flow, different ways they appreciate, and we're going to talk about that. Level of effort and risk, these are really important because sometimes people see numbers out there and they're like, oh, that's a high number, I'm going to jump in and do that. Well, you got to think about, what is the level of effort you actually want to, use or participate in your investment. So like fix and flips, great numbers, a lot of work, which is totally okay for some people, not okay for me, which is why when I dabbled in them, it wasn't successful. And then we're also going to talk about money needed to get started and hold period. So real estate is not liquid, right? Single family homes are as close to liquid as possible. Like Leah and I were talking about before we hit record, is that if you're in single family homes, you can buy or sell them within a 30-day time period. If you are in apartment buildings, and it might take 60 days to buy or sell an apartment building, 6 months. 60 days is amazing when that can happen, but it's often a very long time period, and everyone goes in together, everyone exits together. So really know for yourself if, along with risk, if liquidity is important to you based on your goals and what you're looking to do, because that's going to influence what type of investment you jump into. All right, so if you're interested in really exploring this chart, I think we do the chart on the second day of Freedom in 3. But anyway, sign up for it, and I'm going to spend an hour going through this chart. But basically, these are numbers that I've seen over the last 10 years, either that I've experienced or when I speak to people like Leah who are talking about like, hey, this is what I'm experiencing in the market. And so these numbers change. They're different depending on what market you're in, which is why the second half of today, we're going to talk about market, because it's so important. Single family home rentals, annual ROI. Normally people buy for cash flow on single family homes, which is why these numbers are similar. 5 to 15% is a huge difference in range. It could be negative 10% if you're in California. Leah might be getting 30% on some of her stuff as far as cash flow. I don't know. But because it's a different market, there's going to be even higher than 30% cash flow. Yeah, nice. So yeah,
cash out and have no money in it. That's why cash on cash is our kind of gold standard.
Yeah, there you go. So, and that's why it's so important to know what's important to you and what market you're going to go get into. Flipping, this is a great way to make some cash. It's totally not passive, right? So level of effort is high. I find it a bit risky, but that's because I'm in California and if you fix and flip something, you're talking about millions of dollars. So, but you can get started around 40K in other markets, and it can be more profitable. There's all kinds of syndications that are now going to be listed. So, and I'm going to explain in a second what a syndication is, but it's basically a group investment, meaning you're not on the loan, you're not in charge of what's going on. You put your money in and you sit back and someone else does the work. So you can do this with hotels, you can do this with apartments, you can do this with funds and storage units, mobile home parks. These are all kinds of syndications that you can find out there. And so when you're doing your due diligence on making an investment, if these numbers seem attractive to you, you're going to want to be able to do due diligence on these types of asset classes and also the market. Okay, so I'm going to talk about really quickly what is a syndication for those of you who want to be in real estate but don't want to do anything. Now, there's other ways to be in real estate and not do anything. There's funds. There's, I think what Leah works with her clients, and we'll talk about that as well. But I do, my point is pointing out, until I learned about syndications, I didn't know there was a passive way to be in real estate. I thought the only way to be in real estate was single family home rentals and, me being on the deed and the loan and managing a property management company. So it was a huge relief to me when I found syndications and realized like, oh, I can just park my money and walk away and get the quarterly checks. It's really cool. So I'm going to dive in and talk about what it is. My example is going to be with multifamily because that's what I do. But this structure is the same if you want a medical office park, if you want a commercial retail park. There's so many cool things that you can invest in passively. So I'll take this example. So say we want to buy this $1 million apartment building, and say the purchase price is $1 million. We go get a loan for 70%. This varies, right? Depending on what's going on in the economy and the market. It could be 60%, it could be 80%. For the sake of this model, we'll just generally say we get a 70% loan to value. Then we need a down payment. So we could put in our own money of $300,000, and then maybe that's the only, apartment building we could acquire. However, if we go out to investors and say, hey, who wants to invest in this? And you'll get a piece of the pie, then we can do this multiple times. So we've now done this 16 times by going out to investors and asking if they want to invest, and then we've increased our portfolio that way. So what we do is we take this apartment building and we put it in an LLC. Okay, and so investors are members of that LLC. Their name is not on the loan, they're not on the deed. The tenants don't know who they are. The property management company doesn't know who they are. They have to do nothing, but they hold equity ownership in the LLC that holds the apartment building. Now, the sole purpose of that LLC is to run that apartment building as effectively and efficiently as possible. And the general partners of that LLC are in charge of doing that. So that would be me and my partners. So how is it structured? So in an LLC, you have the general partners and the limited partners, and then we have a loan. So when we go to make the purchase, this is how the pie is basically divvied up. And so say we have 30% of the capital required to make this purchase comes from the limited partners. What we do is we turn around, and on the equity side, we give 70% of that to the investors. Now, this pie ratio is really important to know because that is where you're going to get your appreciation. So it's not for 30% of the purchase price, you get 30% ownership. 30% of the purchase price gives investors 70% ownership. And so as we're doing a value add program on the property, investors are getting that equity lift, that appreciation on 70% of their ownership. And again, it's ownership of the LLC that holds the building. So you get all the pass-through benefits of real estate, like the losses, the bonus depreciation, etc. But you don't get any of the headache. You're not on the loan, the deed, etc. You're totally hands off. So at a high level, that's a syndication, and it can be, like I said, apartment buildings. It can be, it can be storage units. It can be mobile home parks. It can be anything. So what you're going to want to do is figure out what asset class is attractive to you, depending on what's going on in the economy. You're going to want to find a team, do some great due diligence on them, And then you're going to want to do some amazing due diligence on the market, because the number one thing that causes investments to go wrong are the people involved. And the number two reason investments go wrong is choosing the market wrong. And so it's almost always you can make the numbers seem as good as you want for, an individual property in your marketing material, which is usually what people look at first. But I always encourage people to go backwards. I'm going to skip through this because we're going to talk about market today. Oh, excuse me. Okay, due diligence. So like I said, you want to start with the people, and the way you do that is stuff like today, right? You're on this webinar, those of you who are here who've been following Leah or your clients of Leah, like you got to know her, even though it's remotely through Zoom, over the years before you started working with her, right? And so same thing with me, people, this is part of your due diligence, is learning about the people involved in your investment space. And then second, you're going to want to do due diligence on the market. So when people talk about the real estate market of the United States, and feel free to chime in here, Leah, this is going to be my last slide. But it grates, it irritates me so much. It's in the media, it's out there where people say, oh, the United States real estate market. And it's like, no, there's not a United States real estate market. California, Florida, totally different markets. San Francisco, LA, totally different markets. So you need to get super, super localized when you're talking about what market to invest in. And it doesn't matter if you're investing in a syndication, a mobile home park, single family homes, whatever it is, you need to get super, super localized and data driven on your market research. So population, job announcement, job growth, vacancy rates, market rents. You're not looking at that at the US level or even at the state level. You're going to be looking at that at the city level, the MSA level, and think about how it affects the asset class that you're looking to go into. And so we're going to spend the rest of our time talking about this, but once you choose a market to invest in, and then you're looking for the individual property, whether it's a single family home rental or multifamily apartments or whatever it is, you're going to want to look at that property and compare it to what's going on in the market. And that's going to tell you how much of a value add proposition is available with this property, right? So not so much vacancy rates when you're looking at a single family home, but you want to say, okay, what's going on in this property? Where are rents based on market? What levers can I pull to make this property better according to what's going on in the market? So the data on the property, you're going to want to compare that to the market. So I'm going to stop sharing, and then now we're going to dive into the market. So I'll start by saying we have 5 apartment buildings in Texas, and we're about to acquire 3 more apartment buildings in Texas. So the acquisitions over the next 60 days, it should be close to 550 units there. And we're totally excited because it's a great market. And Leah, you said in the beginning a bit about your portfolio in Texas. So I'd love to hand it off to you, since I've just talked for the first half hour, and here, because I'm not in Texas, right? Each time I do an apartment acquisition, I'm partnering with someone who lives in Texas. And I think that's really, really important. And since you live there, you've been investing there since 2006, you said, like, you have the really great knowledge. You're a great person for people to not only get knowledge from, but, partner with, to be clients with you, because you're there, you're living it. You're not in New York and doing something in Texas. So I'll hand it over to you. Tell us a bit about what you've been experiencing in Texas over the last 2 years, because that tells a great story, right? And then what you're looking to do, not only in the next 30 days, but like in the next year.
I feel like we should spend 15 minutes diving into why you haven't moved here.
Yes, my family lives here.
It's funny. I can't tell you how many clients come invest here and then move here. And it's very different than the other markets to live here.
Oh,
we're
yeah.
hot, we're dry, we're not humid. And so I love it. But, those of you from California, you're like, I couldn't take this weather. So our market's really interesting. And the last 2 years has really been, I think, the biggest showpiece for what Texas can do, and specifically North Texas. So I'll start by saying I cover about 70% of Texas. So I'm familiar with all of the markets here. I originally started working in Houston back in the early for sale by owner days. So I've watched Houston. I watched it before the crash, during the crash, after the crash. And the thing about North Texas is diversification. And if you go back to my classes from 5, 6, 7 years ago, I'm saying the same thing I'm saying now. The difference is the numbers now are beyond what I think any of us could have even foresaw. So if you go back to the crash, while we were all struggling and the world was in chaos, North Texas was growing our infrastructure. Crazy, right? We were building our highways, we were building our airports, because people a lot smarter than me knew Texas was going to be the one that was standing out in the crowd after everything kind of went back to normal. And what happened is the Texas Enterprise Fund went crazy. And for those of you that don't know what that is, essentially it's a deal where you can bring your business to Texas and agree to invest so much money, and we're going to give you this in return in tax benefits or cash or whatever. So if you watched the news yesterday, you saw that Caterpillar is now moving their corporate office here. They participated in this enterprise fund, the types of things that got Liberty Mutual and State Farm and Texas Instruments and all of these companies to grow here. And so, just a couple of weeks ago, the largest economic deal in Texas history was just struck in one of our largest markets we work, Sherman, Texas, for Texas Instruments. And so Texas is very smart, right? It's not just that we're business friendly. It's not just no state income tax or any of the other great reasons to invest here, but it's about our business mindset and how we have used our money to incentivize businesses to come here. And so going back to the last 2 years, COVID made it really easy to convince businesses. It made it really easy to convince people. We already were getting something like 545 new residents a day when I was teaching at the point right before COVID started. I went to an event and we were talking about this, and it was 545 a day. COVID hit. Yeah, work from home started. And now all of a sudden, we're not just 545, we're anyone who's working from home, anyone who's not working. Why not come to Texas? Why not come to Florida? And so what we've seen is this massive integration of people coming here. Now, why is that important? So we were already going into COVID, Dallas County, for example, 50% renters, Tarrant County, that's Fort Worth side, 40% renters. And so we already had this massive rental need here because most people aren't buying homes, or at least they weren't at that time. Texans in general were just not buying homes. A lot of millennials, I'm sure you guys know millennials, we have the highest savings rate, we have the highest education level, we are the richest. That is what we've kind of been bred to do. But the problem is we don't like commitment. A lot of us aren't having kids, we're not buying homes. And so what happened is we already had a strained rental market with a housing shortage. So going into COVID, we had a housing shortage of about 40,000 homes.
It's huge.
It's huge. Guess what it is today? 170,000 homes. 170,000 homes.
Wow.
Now, they can't fill that need. 5 years minimum. That was before the builders quit. So what's happening now? Flash forward to today. So we had 40,000 home shortage. We're all out there preaching it's going to get worse. It's going to get worse. They're dropping rates. Rates are at all-time lows. Builders are trying to keep up. Building supplies skyrocket. Prices skyrocket. So we've gone up like 40% in 2.5 years. Now what? The builders are slowing down. Builders like D.R. Horton are saying, we're not even going to build 2-story homes because we can't source the material. The lots are ridiculously priced and completely overpriced for what those of us that were building want to do. And the people who are building, they don't want to go build up in the burbs. They want to go down in the city where they're going to make a lot more money. And the problem is we put all of these new apartment units online. And those of you who know me, you know apartments are not my thing. I own a lot of apartments. They're just not my thing. They're a necessary evil and they're great for passive. They're not my cup of tea. But the reason apartments are a problem, so you have everyone coming to Texas buying apartments and renovating them. So even your Class Cs look like Class As. All of the new apartments have to compete with that. So they're building them at A+ standards, massive rent expenses because they have these huge amenity packages. I speak all the time at these events and it's amenity, amenity, amenity. I mean, they have dog parks for dog parks. It's insane. It's crazy. But the rents are ridiculous. So we've taken this need and they're like, well, there's this housing shortage. Let's build apartments. And then the world comes in and says, let's have a virus where nobody wants to live in apartments. And so it's really exacerbated an underlying issue. So that opportunity is very unique because now we look at rising interest rates. We look at the builders slowing down. We look at lack of inventory. We look at So here's the other problem. And this is something that they're not talking about. Everyone's so worried about a crash, but this is nothing like '08. And let me tell you why. Number one, everyone has equity. Everyone has equity. Number two, they can't go anywhere cheaper. They're locked in at 2% and 3% interest rates. For them to go move, the apartment's going to cost them 30% more. To buy a new home, it's going to be $1,500, $1,200 a month more because of where rates are today. No one's going to move. They will figure it out. They will modify those loans. They will figure it out because no one is going to spend more. So we're in this unique situation now. We've got this massive housing shortage. A lot of people were praying for a crash, hoping they could swoop in and buy at that point. Well, that sure as heck is not going to happen here in Texas. And so at least not this part of Texas. So now as investors, it's like, okay, what do we do? Well, if you're me, you're buying up as much property as you can. And so it's very much about what model works for you. Now, when I hear all these people talking about, oh, the market's going to crash, the market's going to crash. The stock market might, the housing market,
the Bitcoin market, the crypto market,
the gambling.
Yeah.
The houses are going to keep going up. It's just a fact. And the reason is because it's supply and demand. You know, they release a new video game system and all of our kids want it. What happens? People start selling them at 2, 3, 4 times their value. Did the prices go back down? No, they're still ridiculous, but they were able to fix the need. They were able to fix the supply and demand issue. It's not possible right now. It's not possible. And every time they think they've got a handle on it, you know, wood went down 12, 13%. Awesome. Oh crap. The gas to transport, it's up 40%. Every day it's a new hit.
Yeah.
So for those of us that are investing in real estate to make money, we're all ecstatic. Are we sympathetic to what's happening to the American people? So let's take a second for this. Yeah, absolutely. Am I sympathetic to the fact that I went to lunch the other day at a nice restaurant and the waitress was telling me she was having to pick between groceries and gas to get to work? Yeah, it's awful. But if we look at it from the investment perspective right now, might even be as good of a time as what it was 3 years ago before all the gains. And so it's just, you have to drown out the noise. And Sarah, you hit the nail on the head. This whole national market speak, that doesn't talk about Florida. That doesn't talk about Texas. It talks about the overall market. But Texas here, just our area of North Texas, we're the 24th largest economy in the world. We're larger than most countries. Texas is like the 9th largest economy in the world. We are quite literally our own country. We're part of the US, but we are carrying the US. And that's the piece that you're never going to get from national news. And so those of us that are here local, you're right. We know what's going on. We know where to park our money, and we're making boo-boos because we buy property and we have this equity, we cash out, we take that money, we buy more. And so we have like no equity in any of our properties that we've had to put in. It's all from gains. And so the cash on cash return is infinite. That's the game. At least that's my game.
Yep. And I'm totally like that game is not even a game. It's so real life. And I want people to hear that because that's also something that we look at. I think it's on the 3rd day of the Freedom in 3 challenge is how to maximize your cash flow by leveraging. So there's a lot of people who are afraid to leverage, and it's like, that's going to keep you so small. So the people who leverage, and not just like leverage for the heck of it, but smartly know what's going on and leverage responsibly and intelligently, they are massively multiplying their portfolio and cash flow, right? Like just what Leah said. And those who are buying all cash and just sitting on it, they're stunting, they're limiting their growth. And so I think it would be interesting if you could kind of dive into maybe an example of exactly how you're doing that, even given the fact that rates are going crazy and all of that, because I really want people to hear that because it's a big shift in a lot of people's mind.
Yeah. So, you know, we have 2 kind of different models that we work. And so what I do for my own investment journey is different than what most of our customers do. And that's because what I do is a little crazy, right? So I buy homes that are borderline demolition and we fix them up and we get massive gains from that. But, you know, you look at how Zillow failed in North Texas, it's because they didn't have the vendors to make the repairs, right? They bought all this inventory to fix it up and flip it for a profit and nobody wanted to come do the work. You know, you look at a market like where we are, there's a shortage of vendors. And that's one of the reasons why at my company, we have all of our maintenance in-house. It's because we can control it. We can guarantee the timing. We can do all of those things. And so there's really two different models. Most of what our customers do is a semi-passive, meaning that it's new or brand new properties. They buy them in these emerging markets where they're the fastest growing MSA, like Sherman and Denison, where there's more jobs than there are people to work those jobs. One area outside. So if we look at like the core city, Dallas doesn't grow from within. Dallas grows in the suburbs. So all of the Fortune 500s coming here go to the suburbs. Almost 100% of them are in the suburbs. And so what happens is we want to be drivable to that, but also in these larger suburbs that have their own employment centers. And so that's what Sherman, Denison, Greenville, our major markets allow. So we sell in about 25 suburbs of Dallas, but we don't, in the main city, we stay away unless it's just a stellar people and it's one of the nicer areas. And so what we really find is that we're in this unique situation where these areas aren't just appreciating because the market's appreciating, they're appreciating because the actual property is now in a bigger city, a more desirable city, because these cities are growing so quickly. So you look at Dallas, it's had net population loss. You look at the suburbs we work in, and in the last decade, they've had like almost 40% growth, and they had over 1% last year. And so it's a very different model. And so we do these recently built or recently remodeled or brand new homes. We tenant them up. We do a 2 to 6 year hold period. So what that means is we're monitoring the market, we're monitoring your equity. And once you have enough equity from that appreciation gain, which most of us got in less than 2 years, we have two options. We either refinance it, take that cash out and go reinvest, or we sell again and we 1031 back into 2 properties. A lot of our clients took 1 and turned it into 3. And so that is our model. And we're constantly doing that process. And that is how we retire our customers. And so there's really 2 different paths. There's the, like you mentioned, the cash flow path, and that's where most people are. But it's also about the big gains are the price growth, and the price growth of those areas is paramount. And so that suburb play, that tertiary play, that really is where we focus. And even in my properties where we're doing these full renovations and borderline demos, we're still in the same markets. And I dabble with new construction, recently remodeled, same thing. I bought like 10 this month. I think 7 of them were rehabs. 1 was a very light rehab and 2 were so we follow the same model. I just do it at a much higher volume, and I can afford to take those risks.
Yeah, I love that. Something key I want you guys to hear. She takes 1 for her clients and turns it into 3. Like, you're making the houses have babies. It's great.
Well, and so here's the thing, and this is what any class I teach, I touch on this. You have to look at how much equity you have in a home when you're calculating your return, whether it's an apartment, a home, a warehouse, a commercial building, whatever. I own commercial too. Not my favorite, but I own them. I think that people forget, just because you put 20% down, your return is not based on that 20%. Your return is based on however much equity is in that property today. So our long-term holders, our real estate, the people that have been in this a while, it's hold, cash flow. But you forget, okay, so you had 20%, you were making 10%. You now have 40%, you're now making half, because you have just about the same income on twice as much money in the deal. And so sitting in those properties makes no sense. The Dave Ramsey mentality, save, or pay down. That doesn't get you to the lifestyle that we all want. And that certainly doesn't get you the financial security. And I've been talking about this a lot, the inflation risk, and whatever you think you need to retire, double it, because look at what's happening right now. This could have happened. And all of these people who retired on fixed income or just on the Dave Ramsey mentality, what are they doing now? Right. I use the example of the people who RV for a living. They've retired and they just travel the country. They're spending $800 to fill up their RV. Yeah. I'm in an RV group with people talking about they're just parked because they can't afford to use the gas.
Oh my gosh.
But that is the mentality, and that is the reality of not having passive cash flow. For me, my number was $1 million. That was my number. And I said it a long time ago. The problem is you set a number and you hit it, and then you're like, okay, what now?
Yeah.
And so I find my clients that are just getting started and they do a couple and they go really well, then they start getting really aggressive and really excited. And that's a very different type of investor from someone who's been doing this for 30 years. And so when I speak to people who've been doing the same model, it's a lot of retraining. It's a lot of showing you why, because I could talk about how rents go up at a lower pace than value. And so there's a disparagement every year where your returns dropping on a yearly basis. I can talk about aging systems and increased cost of repairs. Like I can talk until I'm blue, but at the end of the day, you have to pick what feels right for you. And so if you're one of those that you just want to hold on to the same property for 20 years, totally fine, totally fine. I wouldn't hold it past 27 and a half though, because you don't want to lose your depreciation. But, we're all just looking for a model that works for us. And my goal and your goal is to just show you what different models look like, what's working for us. There's so many people out there teaching models that they don't follow. I can't tell you how many gurus I know who own nothing. And so that's a very big reality. And as the market kind of does these fluctuations, which some of us get really excited about, a lot of people get out there talking and chatting and trying to strategize. Make sure you vet who you're using for your guidance, because if they're not out there living their dream and using that model to make money, probably not a model I'd be real confident in.
Yeah, 100%. I agree with that. I want to pull out two things from what you said that I'm super passionate about. So in our syndications, like, yeah, there's people who are syndicators and they don't put their own money in. For our apartment buildings, I tell everyone each time, like, okay, on this one, I'm putting in 250K. On this one, I'm putting in 400K, whatever the number is, because I 100% believe that to get to my core value of time freedom is I need to be completely passive. So I'm following the same model that I suggest to everyone. And another thing that I love that you said was talking about when investors look at their cash on cash return and then the value of the property has gone up. So there's something, and I also teach this in the Freedom in 3 class I'm doing next week, is the concept of return on asset. So instead of a return on the capital you put in, the actual return on your asset. So if it was worth 100,000 when you bought it, and now it's worth 200,000, like you have an extra $100,000 that you should be using in your calculation when you're talking about cash on cash. And if your rent, your income from that investment has not gone up at the same speed, like you said, it rarely does, right? Then pull that out, buy more, put that in something else, get your cash, your return on your asset to be maximized, because you're kidding yourself if you think you're still getting a great cash on cash return, because it's actually what do they call it, like house poor if it's what you're living in, but that can also be the same for your investments, right?
Well, and the problem is that, there's this big teaching of just cash out, just cash out. The problem is because of that rent disparagement, oftentimes it makes a lot more sense to sell 1031 and buy new, because you can buy in at a better return than what this now more expensive property is. So our sweet spot is $250,000 or less in value for single family. And so when we have these single family homes that get up to 280, 290, 300, the return is no longer as good as what we can get in the cheaper price point. And it baffles me. You've got all these hedge funds and people coming and buying these expensive homes, and they call it they're wetting their feet, right? And they're buying these $500,000 homes in North Texas because they're banking on the price growth. And yeah, the price growth has been crazy. Totally understand that. But why would I get a $500,000 or $600,000 home to rent it at $3,000 a month when I can get a $200,000 home and rent it for $1,600 a month? And so there's just a lot of misconception about what price point to buy in, what area to buy in. And this cash out model, it does work, don't get me wrong, but it really works when the value hasn't yet gone up. So it works in value plays where you're putting money in and getting sweat equity. It doesn't really work when you have appreciation equity. And so it's a fine line that even people like me walk, because when you get to the number of properties that I do, you can't feasibly 1031 every single one that gets up to a value like that. And so I have a spreadsheet with formulas I've created, and I'm running them on a monthly basis, trying to decide what to do with every property. I treat every property as its own business, every property as its own investment. I don't look at things as a whole. I do from a cash flow perspective of, oh, I'm making this much a month now. But other than that, every property has to be separately analyzed, separately looked at. And we, as the property manager and the investment sales team, we look at that every year for our clients. But for you that are self-managing or managing your own, or you're with other people and they're not doing that for you, you need to make sure on a biannual basis minimum, you look at every property, how much you put in, how much you're making. And it's really important because if you want to maximize your wealth and you want to maximize your portfolio, it goes back to what you said, Sarah. You can buy one property with 300,000 down, or you can pool a lot of people and buy a lot more. Treat your own investment strategy the same way. You're not going to retire on 3 properties. The goal is to use whatever you have and keep moving. And so most people who are on a fixed salary, a fixed employment basis, you have to have the money that you've put in to keep going. You have to use that equity to keep going. And so for you, 1031ing is going to make the most sense. For people like Sarah, for people like me, we are constantly adding cash into our bucket so we can keep moving without that. And so the goal is that you get to a point where you can transition to that. But in the beginning, most people, you have to be open to 1031s because that's how you go from this number to this number to this number. I started 5 years ago with 4 properties 5 years ago. And I can tell you that as of today, based on my cash outs and my refinances and everything else, I have close to $0 in all my properties.
It's pretty
That's the
beautiful.
power of 1031s and cash outs. And it can be done. It can be done. And you don't have to be wealthy when you start to do it. You just have to be smart and aggressive. And you have to watch your numbers and constantly look at them and not be afraid to make the decision to liquidate.
Yeah, I love it. And I see some chats from people saying like totally inspiring. And yeah, it's totally inspiring the amount of time that you've done that in. And it's because you've chosen great markets. You could not have done that in California or, like random other places in the United States. That's why, but you have been so successful because you chose a really great market for
And I
that.
really wish I'd started years earlier. It's funny, a lot of us that are in this industry, we get so busy helping our clients that we kind of forget to help ourselves. And so 5 years ago, we're sitting around and we've got thousands of people with property, and we're like, we need to go buy property. Like, what are we doing?
Yeah.
And I talked to another top guru, I hate that word, but it is what it is, an expert. And she's like, I should have been doing this 10 years ago. So we're all stockpiling cash and not buying property. Cash doesn't get you anywhere. That little, 0.25% return in the bank account is not going to make you to the next level. So
Yeah, definitely not. Um, okay, so let's talk about some of this. So you talked about tertiary markets. So like Dallas, not in the core city, but kind of in the surrounding neighborhoods. And you talked a little bit about Houston as well. What are those the 2 places where you're really focused right now?
So I actually only sell North Texas.
Okay.
I manage the other areas, but I don't believe in their stability.
Okay.
North Texas is so unique, diversification of employment. We're back down to almost a 3% unemployment rate. We have more jobs than we have people to fill them. We've got almost 2 jobs for every person. There's a lot of reasons why North Texas is where we focus. So we help people with their portfolio in other markets. And Houston, it definitely is more promising now than what it was.
Yeah.
It's still way too energy and oil and gas dependent. And that just brings me a lot of pause because, and this is not a political statement, doesn't matter if you're left or right, but Republican presidencies, oil and gas tank, and Democratic presidencies, it goes up. And so your investment kind of looks like this. And the other problem is the storms, the flooding. There's just a lot more risk factors in coastal areas that bring me pause. And so for me, it's about the easiest, most passive investment I can possibly own or offer. And I don't feel like Houston, San Antonio, Austin offer that. I also have grave concerns of Austin's pricing. And I think that Austin is significantly overpriced, and I don't think it has the employment to back it up, not enough. I think that if we ever do get back into a crash, whenever that is, and I don't think we're even in a realm of where that's going to happen, but if we ever did, I think Austin's going to go first.
I'm gonna because as you're saying, so a lot of people are familiar with Texas, but I'm gonna share a map because it might help those of you who are a lot of people who I invited are from California, and so you might not know Texas as well. So I'm just gonna bring it up. So when Leah's talking about North Texas, you could see it's like Dallas and the northern areas. Now, what about like even more north, like Amarillo?
We don't touch it. I don't go into the handle. I don't go down to the border. Again, too many complexities. We don't want to be in Tornado Alley. There's 100 reasons why, but really at the end of the day, with what DFW offers and the incredible opportunity and all of the boxes are checked in the best way, there's really just no need to look anywhere else. You can diversify so much within Dallas itself. So let me throw some more statistics at you since I'm a
Yes.
numbers person. Let me throw a few more out there.
Yes.
So DFW is now the fourth largest metropolitan area in the United States. We're the fourth largest market, right? So population wise, we're number 4. We're slated to overtake Chicago in the next 10 to 15 years. So we'll be number 3. Our average home price in the suburbs we work is still $250,000 to $300,000. What's your average home price in our other top 3? Chicago, LA, San Francisco. What's your top
Yes.
number? New York.
The average home
Right?
price around me is about 2.5 million.
So let's think about that for a minute. We have better jobs. We have a lower cost of living. Our average home
Oh.
price is almost 10% of what yours is in another top market.
Yep.
DFW physically is undervalued. It's been undervalued. We knew it. This is so much more. They call it appreciation. They can call it whatever they want. I read an article last week. I laughed out loud that DFW is 50% overpriced. Yeah. So our homes should be worth 125 in a top market. The problem is people look at us as the underdog. We have grown so silently. People are just now starting to look at us, but the investors are smart. It came out that almost 50% of the homes sold in Tarrant County, Fort Worth side last year were to investors. Why is that? Because we watch the markets. We don't listen to the news. We go look at the numbers. We look at employment relocations. We look at the enterprise fund. We're looking at other statistics the news doesn't care about. That's not what sells. They care about what gets people riled up.
Mhm.
We're not riling people up. We are just quietly growing, and we have gotten massive. When I was growing up, DFW was a nothing. It was, I'm born and raised here. My husband's born and raised here. I never left. We were a nothing. And now we've just kind of silently gotten to this mega state. But the problem is we're still so underpriced. So let's say the market softens. Let's say the market softens. People are going to keep moving to DFW for the job market. We're still going to have a housing shortage. People are still going to be moving from a market where they're used to spending $1 million, $1.5 million for what they can get here for 300,000, 400,000. What's going to happen? The problem is the prices are being driven up by bidders, cash buyers, hedge funds, investors. There's more buyers than there's going to be property to sell for years and years and years. So by the time we're out of this recession, Dallas isn't going to have felt it because we're still going to be in a shortage. So what I think is going to happen, I don't have a crystal ball, so don't hold me to this, but what I think is going to happen, I think we're going to have a complete change in November. The mentality is going to go back way more positive. I think they're going to start pulling back on rates. And I think next summer is going to be absolutely insane. That's exactly what I think is going to happen. And I'm banking on that. Do I think there's going to be parts of the country that are going to really get hit hard? Oh, yeah. Oh, yeah. I think California and New York are never going to look the same. I mean, y'all are having such population loss. We gained a congressman from you guys because so many of your people came here, and it's going to keep happening. And so I think what's going to happen is if I were to look 50 years in the future, I think DFW is going to be a top 2 market. I really do. And I think that it's such a cycle now. I don't know how it stops.
I hear this from investors a lot, so I'd like to hear your opinion because I'm in California, and yes, so many people are moving. A lot of people are going to Austin, but also to Colorado and other places. But a lot of people's worry is that with so many Californians being like basically relocated and being concentrated in another market, that they're going to make the same, I don't want to, I'm just going to say it, like stupid rules, and
they're going to turn Texas. Don't California my Texas.
So what do you think about that?
You know, when they started the chance that Beto was going to win and that he was going to take governorship of Texas and turn it blue, we're all laughing. There's more guns in Texas household than there are kids. I mean, we are a conservative state. We are a business conservative state. We are a landlord friendly state. Are there areas that are back to those California ideals? Yeah. But they've always been that way. Dallas has always been that way. Austin has always been that way. This is nothing new. Does it make for good news to blame it on the influx of Californians? Yeah, I mean, it does, right? It creates fear and it creates chatter. But at the end of the day, I can tell you that a lot of the Californians I meet here, the ones that left, it's not the ones that made California the way it is. It's the ones that wanted out. And I think there's also been a big shift. I think we've had so much chaos and so much turmoil, and COVID really kind of did it in. Your people who really were very pro California that left during COVID, they realized how all of that restriction limited their life. And they're kind of a bit more moderate now. We see it when we're talking to people, when we're interviewing people, when we're teaching classes. It's a much more moderate base now. And I'm not talking politically. I'm just talking from a standpoint of financial, ideas. And so Texas isn't going to turn blue. I can tell you that 100%. Texas is going to stay extremely strict, extremely business friendly, extremely landlord friendly. Are there going to be cities that try to implement things? Absolutely. Dallas is talking about banning short-term rentals and doing all sorts of things. There's rental registration programs. At the end of the day, does any of it really affect our return? No. Does it affect the growth of the city? Nope. Nope. So we have a few more people getting benefits. We have a few more programs out there for people who are struggling. I don't have a problem with any of that. Just don't let it leak into the financial backing of the state, and it won't. And so I think it's core values at the end of the day of what Texans believe and how business should be run. And I don't see that changing. My husband's in politics. He's on city council, and we're real involved with the parties here. And, there's a lot of fear around the inner cities and what's going to happen within the inner cities themselves with laws and changes for landlords and things. But at the end of the day, statewide, we're still as conservative as we've ever been.
Awesome. Well, we are right at the top of the hour. So Leah, I'm going to stay for questions. I don't know if you can. There were a lot of questions in the chat that we just kind of kept going because we're on a roll. So I'll say to the audience, if you need to jump because we're at the top of the hour, I'm going to say thank you so much for being here. And thank you for being here, Leah. Like, I love your outlook on so many things. Like, in chaos is opportunity. Like, how can we be creative and maximize and really pay attention to what's actually going on, not paying attention to what's going on in the media, not paying attention to that hype that's out there. Like, let's just get real, focus on what's good, be intentional about our investing, how it can support our lifestyle, and live, according to what's actually going on instead of all that fluff out there. So
I think about, none of these people on the news or writing these articles are investors. I read the one I mentioned where they said that DFW is 50% overvalued. It was a nobody, but because of what they said in that article, it went everywhere. It went viral. And this is the problem with today's world. And I'm not going to get on a soapbox, but what you mentioned, that things are much more fast reacting now. Social media is the downfall of news. And it's because the louder you talk and the more aggressive what you say is, and the more radical, the more attention you get. And so those of us, we really I dig in the news. I mean, I read all night to find the actual information.
Actual news.
Yeah, not opinion. I don't need opinion. I have plenty of my own, I promise you. What I need is the facts to form my opinion. Yes. And the problem is right now there's a lot of noise, and the noise is not from experts. The noise is from people who know how to make a lot of noise. And so you really have to kind of weed that out. Yes,
100% believe that. Okay, I'm going to dig in and just start looking at the chat and the questions. Oh my God. Okay, so I'm going to start at the Q&A. So let's see, we have a question. Could you address buying for appreciation, given it's a roll of the dice? Is it not better to buy on a passive cash flow criteria based on cash return number? Appreciation then becomes cherry on top. I 100% agree with that.
When we do our pro formas and we send out available properties, we actually don't even factor any appreciation. Yeah. It's 100% based on the cash flow.
Yep, there we go. Would you consider it not too late to jump into the single family home market?
No. What's too late? When we're still in a housing shortage, we went up 20+% last year. That's not too soon. If we were dropping to 2 or 3% appreciation and we didn't have jobs, maybe we'd be having a different conversation, but I don't think we're going to be having that talk anytime soon.
There we go. So someone's saying, so buy based on cash, but monitor return on asset. I'd say 100% you got it.
I still call it cash on cash. I just look at how much cash equity we now have in the asset, but it's saying the same thing.
Yeah, perfect. Okay, I'd be interested to know how much of the gains are due to demand versus decreasing value of the US dollar. In other words, since prices are increasing, how much purchasing power do you gain, or is it more of a question of maintaining purchasing power? I believe in North Texas, you're seeing both gain of purchasing power due to increasing demand, but what's the real return? It's a big
Well,
question.
it is. I think there are areas right now where the value of the dollar is really affecting the real estate market, and specifically areas like where you live, Sarah. But here, it's 100% that we're undervalued. We have a lot of people that came with a lot of cash because they sold out of areas where they had a lot of equity.
Yeah.
And then they also were used to the type of market DFW really should have based on its size. And so, yes, they did help correct our market and do a proper market for a market this size, multiple offers, bidding over asking. You know, there's a joke right now, if you don't have 50,000 cash to pay over asking price, don't even bother. And that really is kind of what our market is right now. It's not as crazy as California, but it certainly is not what DFW is used to. But in reality, it's just we're resetting back to what we really should have been in the first place based on our market size.
And if you're in a different market, so David, to expand on an answer, like it's a good thing, even if you are just keeping up your purchase power. That is one of the beautiful things about real estate is during an insane period of CPI going up and inflation and all of that. If you're in real estate, maybe your purchasing power stays the same, but your purchasing power stays the same. So that is a major win, because if you have it in the bank or you have it in, if we have time later, I'll tell my Bitcoin story. Okay, I won't go into it right now, but it's a way to maintain your purchasing power to stay in real estate, even if you're not even if you're not in the best of market. It's a great way to maintain. All right, so Phil saying I'm interested in Texas syndications as well. So Phil, we have some coming out, so feel free to be in touch. Would love to show them to you. I'm struggling so much because I lost 15K from my 401k since the beginning of the year, and I plan to take that money and invest in some properties in Texas and Florida, but I don't have the cash anymore. What would you recommend?
So number one, when you say take that cash, that makes me concerned you're going to pull it out and pay on it. And that's something that I definitely recommend giving thought to. There are great ways to self-direct and invest from within your 401k to build it. So unless you need the cash flow, there's no reason to take any type of hit or penalty on that right now.
I 100% agree with that. Move it to self-directed. Maybe it's already a solo 401k, so you can self-direct, but I would 100% agree. And unless you need it today, right? If it's for some point in the future,
yeah,
leave it in there.
I have a lot of clients who do self-directed IRAs. We have a great lender, NASB. Jason Zook is who we use for those. We've been working with him for a decade. He's fantastic.
Awesome. So get in touch. All right, Srelia, what are your thoughts on the property taxes in North Texas? Do you think this cuts into the returns investors make?
It's a whole lot cheaper than a state income tax. It's, you know, part of our game is buying into these areas that are growing, that are infill, which makes it very hard for tax assessors to value them properly because they're unique, as opposed to if you buy a brand new home in a neighborhood of brand new homes, it's very easy for them to come in and value in January because every home is identical. They have identical sales, et cetera. Where we operate, it's a mishmash and it's in these growing areas. And so they have a very hard time getting value accurate on tax appraisals. So I say that to say that typically our property taxes are less than what they would be in most of your inner city areas that are more conforming. Additional to that, property taxes are factored into your return. And if your property taxes go up, that means your value's gone up. So you're making money. Again, we're not a state income tax state. And so if you were paying state income taxes, that's going to cost you a whole lot more than property taxes.
There you have it. I get that question all the time too.
Yeah.
Will there be a replay? Yes, it'll be sent out. All right, this one's for you again. I heard Mesquite was not the best place for rentals. What's your perspective?
I'm assuming that you've heard that because of the rental registration program. And Mesquite does have a pretty rigorous inspection program, but Mesquite is not typically an area we sell. That would be less than 1/10% of the inventory that we bring. That's not one of those far out suburbs. So that's not really within our buy box.
There are a few questions about how to get in contact with both of us. So if you want to put your contact information or the best way for people to get in touch with you, put in the chat, and then I'll let everyone know that by registering for this event, you are now in contact with us. So you'll get emails from me, you'll get emails from Leah. You both are now on our email list. So you should see stuff coming from both of us. And my guess is it's the same for you, Leah, that you can hit reply to any of those emails, and then you'll get in touch with someone on our team. All right. So Gary, I think that answers your question. Oh, you're from Georgia. Georgia's a great market as well, Gary. Some really great stuff going on there. All right. Excuse me. Are you seeing the cash on cash return percent drop since rates have gone up and appreciation up? So I'll say it depends on the market rate and the asset class. I'll answer for multifamily. Yes, the cash on cash return is dropping for multifamily. But we heard Leah say not for single family, that she's still seeing the cash on cash go up. Yeah.
It's definitely dropped. There's no doubt. If you factor in with appreciation, returns have overall gone up. But again, we're still only bringing properties that fit our model and our criteria. So and Sarah, not to hit on your market type, so I'm sorry,
Yeah.
but we're at a lot of these big events speaking right now, and there's a lot of very dangerous talks about buying multifamily at virtually zero cap. And, my
Yeah.
problem with multifamily is your operating expenses are much higher I'm not even talking staffing perspective. I'm just talking sheer wear and tear, repairs, turnover, all of that in today's world. And so multifamily for me was always about being able to achieve a higher return than what I could in the single family realm. And right now we're not able to do that. And the multifamily financing has really tightened up. And so I think my fear in the multifamily world is that people are going to continue buying at these very low returns, 4 to 6, 4 to 7% in multifamily. And when I say multifamily, I'm talking apartment complexes, right?
Yeah.
And it's going to be very, very hard to make any money. It's going to be very hard to make any money because when people are cash strapped, they don't take as good a care of their properties. People, they get more stressed. When we see people more stressed, their dogs do more damage. Like there's so many different factors that we've seen over the years. And so it's about having the right person. Sarah's that person to really aggressively model and run numbers on these multifamilies. Where I would discourage people is from buying into deals just to get in. And
Yeah.
there are groups out there preaching that, and
100%.
they just lower their standards. And the problem is we can't lower the standards, certainly not in the multifamily world, because the exit is longer too. So like, if you're a property that you own your own single family, you can get out in 1031 whenever you want. When you're in an apartment, you're part of the deal. You're not exiting until everybody's exiting, and you can't 1031 unless everyone 1031s. And so you have a lot less control. You're more limited. And so for me, that is the reason why I've always bought things that I know I could get rid of quickly. I know many people who've made a lot of money in multifamily. I have one friend that's in 53 passive syndications, and so, or different types of deals. And so there's a lot of money to be made. We just have to be careful that we keep our standards and our expectations the same.
Yeah, 100%. We're seeing that we're putting out more offers right now, and we're losing more offers because people are we're like, how can someone be buying it for that number? I don't know, because they're going to be giving 0% returns to their investors. How are they even making any money themselves?
They're not. They're totally banking on price gain.
Yeah.
And a lot of them are coming from other countries and other markets where they're used to losing money. They're in it for the long term. They just want to have the asset. They don't care how it performs in the few years.
Yeah, it's ridiculous. Some of the stuff that we're seeing. Yeah, the prices that we're seeing.
Yeah, no, I literally was at an event where they were talking about that we may be selling zero caps. My jaw about hit the floor.
We just sold a portfolio in South Carolina. It was $81.5 million. The people buying it making no money. It's literally going to be a zero cash flow. I mean, we were happy to sell it to someone who didn't mind paying that much, right? But we were like, wait, really? You're going to buy it you're going to have 0% cash flow. But like you said, they're buying up half the city. They're just looking to bank on appreciation. But yeah, that's not our model.
Yeah. And, I would never recommend that. I've seen people doing that in markets that I feel are very risky. And, like if you want to make that argument for Dallas, or you want to make that argument for Tampa or some of these other markets, like, all right, I'll listen to you. I'll still tell you you're crazy, but I'll listen to it. But we're talking like rural cities, tiny cities, auto manufacturing dependent cities. Like you're talking your highest risk areas. Scares me.
Yeah, and people do that all the time in California that they buy for zero cash flow. I sold a single family home in February for it was 2.45 million. Now, then I saw about 3 weeks later, they had it on the market to rent it for $4,500 a month. Okay, you know what a mortgage is? They bought it with a mortgage. They didn't buy it all cash. They bought it with a mortgage. A mortgage for a $2.5 million house is more than double $4,500 a month. So I'm like, what the heck are people doing? They're
Well, there's a lot of buying the asset to have it so they can move into it in a year or two. I'm seeing a lot of that right now, especially in our market because inventory is so tight. People are buying a home because they know they're going to come here and renting it out for a year or two. But the crazy thing about our market, our rents went up like 18% last year. Average is like 2.8, 2.9, which makes that
it went down.
disparity. Yeah. Well, so this is it, right? So a lot of Florida and a lot of Texas, all of a sudden our rents just went through the roof. And so for the first time, for a lot of people, it actually made more sense to cash out than to 1031.
Yeah.
But there's a lot of people buying here, and 50% of our buyers are investors right now, and we're not talking mom and pop investors, we're talking billion-dollar funds, and so very, very secure investment acquisitions. And they're okay with 1%, they're okay with 0%, because they know that if things continue on the trend they're on and Dallas continues to actually, I don't know, act like the big market it is, that $250,000 home's probably going to be $500,000.
Yeah. So when you work with your clients, someone's asking if they're non-US residents, do you help them get financing?
Oh yeah, we have all sorts of different options for that. And obviously it's going to be more money down, rates a little higher, but there's still leveraging available.
And I see a lot of questions about turnkey. Is turnkey still, given the current market, is still a good idea? Some different
We don't do
experiences.
turnkey.
Yeah.
Yeah, we don't do turnkey. We're not a turnkey provider. We're a licensed firm. So our fiduciary duty is to our clients. And so we connect you directly and help you acquire. And we have lots of off-market inventory, specifically new construction as well. But if there's meat on the bone, if there's work that's been done, you're buying it direct from a seller. We're not getting that split in the middle. So we get paid as an agent. So a turnkey provider, what that means is someone fixes up the house, they sell it back to you at a big premium, and then you buy that asset. For us, whatever you're buying it at what it's selling for. So if there's meat on that bone, that's all yours. Very different model.
Yeah, very different. Okay, so we got through most of the stuff in the Q&A. I can pop over to the chat. There was a bunch of questions in the chat. I will hit on this. Okay, so someone was talking about, you're opening the door for me to talk about the Bitcoin thing. Okay, so we're not planning to invest in Bitcoin, but we wanted to invest in a fund, and it's a gold fund. However, to invest in that fund, you needed to buy into the fund with Bitcoin. Okay, so weird, but whatever. And we know a bunch of people in this fund and it's been performing great. So we're like, okay, we want to put $100,000 into this fund. So we take money from my bank account, fiat money, and we wire it to Coinbase in San Francisco. We did $110,000. So we're like, okay, Bitcoin is volatile. We want to, if it fluctuates, we want to have 100,000 to then put into the fund. Coinbase freezes our account. They freeze it. We call, they won't tell us why it's frozen. They won't tell us when it'll be unfrozen, but they're holding our $110,000 hostage in Bitcoin. This was on Thursday of last week. What happened between Thursday of last week and this week? We lost 35% of our money. We call every day. Can I talk to someone up higher? No, I don't know why your account is frozen. Yeah, I can't really tell you when we're going to unlock it. So we were not intending to invest in crypto. It was just supposed to be for the day to get our money from here to here to here. It was frozen at Coinbase, a private company, right? This is unregulated space. Whether that's good or bad, I felt like, what the heck, man? I was furious. My husband's furious. So now in order to put our $100,000 into that gold fund, we have to put $25,000 more into this Coinbase Bitcoin. We have to buy more because we lost $35,000 in 5 days. Like,
so you and I both lost a ton of money this week, and you have nothing to show for it. what, it was a
Yeah.
full moon week. Can we just blame it on that? It's just
I
crazy.
was like, yeah. So then my husband's like, well, then now we need to put in another 25K to complete the investment. And I'm like, I don't think I want Coinbase to have another $25,000. They can't tell if they're going to refreeze the account. They can't tell us if we're trying to do that transfer out of there. Maybe they're going to freeze it when we're trying to take it out now that they unfroze it today. It's just like crazy. And I was like, this is why we are not in anything volatile, because it can you just like lose 35% in 5 days. My
It's
gosh.
gambling. It's gambling. I had someone on Facebook, because I'm very active on Facebook. I put all my deals and a lot of followers and
Yeah.
things. And I was talking about, well, who's about to buy into Bitcoin? And one of the gurus starts lecturing me, and he's like, well, you shouldn't be doing that. You should just stick with real estate. I'm like, it's gambling. We get bored. He's like, what do you mean you get bored? It's like, you can only do so much of the same thing over and over. You want to do something exciting. So I bought Doge, I bought Bitcoin, I bought Shiba, whatever it was. But I told my husband, I'm like, this is gambling. It's gone. The minute we put it over there, it's gone. I did the same thing when COVID crashed all the stocks. I bought the airlines, the cruise liners.
Well, that was a good idea.
Oh yeah, we made a fortune. I bought oil because I'm like, oh, just wait, what's coming?
Oh yeah.
We bought 2 Teslas, being prepared, because like those of us who know, we know these patterns. You can only see them so many times before you start to see the signs. But
Yes.
I will say, I'm not a proponent of digital currency, and I don't believe in it as an investment model. But let me speak as a dabbler for a minute.
Okay.
I think in today's climate, today's world, today's information technology, everything's at your fingertips. It only makes sense that digital currency is going to be the way of the future. The question in my mind right now is, what is it going to be? Are they going to take Bitcoin and convert Bitcoin? Are they going to create a new currency? Are they going to create some other form? I don't think there's a question that digital currency is where we're going. We've been off the gold standard for 50 years. We're printing money as fast as we can print it. There's no longer anything tying us to paper money in the current concept of what money and banking is. So we're all fighting it, and we're all, because it's unregulated, very wary on it. And because it's unregulated is why it's so volatile. But I do believe that we are moving towards, and we're going to find, as all these other countries start to adopt it, we're not that far away from where we're going to have to do something. And my hope is that they're going to put some of that money in Bitcoin. But, am I going to bank my fortune on that? Absolutely not.
Absolutely not.
No, but I do think that by the time we're sitting here, Sarah, doing one of these in 20 years, I think we're going to be having a very different conversation about digital currency.
Yeah, totally. And, I see a lot of people saying, hey, Coinbase has done that to hundreds of clients. I had nothing but problems with Coinbase. Stay far away from them. And that's the whole thing, is like, how do you, when it is unregulated, yeah, like, okay, as a private company that froze my money and held it hostage, like nothing to do about it. It's not regulated. So yeah, it'll be really interesting to see where it is once it becomes, it is mainstream, but even more mainstream and regulated.
Once it becomes accepted as currency, like truly, car dealerships are accepting it now. It's going to be really interesting to see. I do think Bitcoin's going to rally. I think it's going to rally big time. I think what happens in November is going to play a big role. I think, if you go back, I do predictions before every election and talk about what I expect. Okay. And one thing that comes from election cycles is instability, and they really highlight everything going wrong because that's how they charge us to go vote, right? So we're in an election cycle. They're not acting like we are, but everything happening right now is gearing us up for November. So next year, things will be really stable and kind of calm. And then we'll go into the next year, and then it's going to get all crazy again. This is just the pattern. And so for me, I like to take advantage of those patterns. And, I do think crypto is going to rebound, but again, who knows?
Yeah, it'll be interesting to see. Mm-hmm. All right, let's see. I see lots of comments. We've gone way off Texas market.
Mine's all with Robinhood. I think I have Coinbase and maybe a few grand in there, but I think everything I have is with Robinhood.
Yeah, we only chose it because this fund was like, you have to fund it from this place, whatever.
Did it give you any second thoughts on the fund?
Say what?
Did it give you any second thoughts on that fund?
No, we were the only person who had problems, apparently. All right. let's see. Someone talking about asking a question about a solo 401k. Does it make more sense to do a single family home or a syndication in a solo 401k?
Single family home, because if you need to asset liquidate so that you can get access to that money, I can't tell you how many times I've had clients that are just starting out and have, just maybe 50,000, 100,000 in, and their kid gets sick or their parent gets sick and they need to liquidate that 401k because they just don't have cash. If you're in a syndication with that, that can get really risky because you might not be able to exit.
Yeah, there's so I work with a lot of, probably 50% of our funding comes from self-directed IRAs or solo 401ks. And we had someone come in and talk to our investors a few times about minimum distributions, like watching out for that, because people who like fully deploy their 401ks and IRAs into non-liquid investments and then they need to take minimum distributions because they've reached that age, they can't. And so what happens when you can't is that then it invalidates the status of the retirement account as non-qualified, right? So you have to answer that question, I would say, what is your age?
And how much is in it?
And how much is in it? And how much, like, if you're working and you're retiring 20 years from now and you have no cash flow problems, like you're making a great cash from your W-2, whatever it is, then I'd say, be passive. But if you're coming close to minimum distributions or you need cash today, yeah, there's a lot of things that would go into answering that for sure. More questions about, yeah, Rick, exactly. Rick is saying, hey, pay attention to your minimum distributions and when you need to take it if you're of the retirement age. All right. More just kind of comments. So I don't see any other questions. If you guys have any questions, not about Bitcoin, I'm not going to answer questions about Bitcoin because I'm totally not a Bitcoin expert.
One from Gary asking if we do the property management or find a third party. We're all in one roof. It's one place for the buying, the management, the resale. It's all under one roof.
Perfect. All right. Well, I'd say we could go ahead and wrap it up now. Are you good?
Yeah, absolutely.
Okay. Well, I'm going to say thanks so much for being here, Leah. And I think it's a beautiful audience that we created together. So some of you guys were invited by Leah, some by me. And I appreciate that you guys were so interactive, being active in chat and Q&A. That makes it way more fun for us, right? So thanks for being here. And any last words you want to say to everyone?
The biggest thing that I'll leave you with is do your research and be comfortable with what you're doing. I tell people all the time, whatever you're investing in, be comfortable with it. You need to be able to sleep at night and you need to be able to know that you're going to have the same quality of life with or without that investment. And so, it's a unique opportunity right now. A lot of us are being very, very aggressive. That said, that doesn't mean that you have to be. We believe now is the time. We believe that things are continuing to present those great opportunities. And then I think that we're going to come out of this and it's going to be another crazy year like we did post-COVID. So, it's about getting educated, be out here doing things like this and read, stay up to date. And the best thing I can say is don't get your news from the news, especially not on the market. Get your localized information. And the other thing I will tell you, if you are in real estate investment loans that are due to be up in the next 24 months, you probably need to be looking at refinancing those.
There we go. Beautiful. Thank you for all the great advice and insight on Texas and single family homes and multiplying your income with leverage and all that. It's just beautiful. Love what you're doing. And thanks for helping so many people. And I look forward to next time.
Absolutely. You just let me know when.
Sounds good. All right. Bye, everyone. See you on the replay.